Gautam Shah joins us. Let's take our conversation forward. Gautam, post the state election verdict, everyone is bullish. What we are measuring is the extent of bullishness. So my first question is that history tells us that markets have always have always moved ahead, moved up in the run-up to the election. There are 4 instances in last 4 in 20 years. So if one works with an assumption that this time it's no different, what to your mind could be the best case scenario for Nifty in the run-up to the elections?
Well, I think in terms of best case scenario, it's an open sky right now because you are at uncharted levels and you really don't know how high this market can go to. And having seen the 2003, 2007 bull market, I for one don't want to really project numbers on the upside. I'm very happy to understand the trajectory. I don't need to know the magnitude. I think the market will tell us, from time to time. But I think the key takeaway for me in the last 6 weeks is how the markets handled the headwinds. Let's not forget in the first week of November, there was a scenario where there was concerns around interest rates, there was concern around geopolitical factors, and there was genuine concerns around what will happen the assembly election results. These 3 major headwinds have been contained really well in the last 6 weeks, and that's probably the reason the market has discounted the same and come back very strongly. And not to forget the domestic liquidity angle that really helped the market sustain at lower levels. So I do believe that this breakout that took place, past 19,850 and then a 1,000-point rally is likely to take the markets higher. But at this point, as we speak, we are a little overbought. There is madness on the screen. There is madness in a lot of stocks and sectors that could lead to a bit of a pullback, but the overall trend is likely to stay strong. And I think if you really look at it from a medium term perspective, our working target as a technician, even though, as I said, numbers don't matter, but 22,300 is now our working target from a medium term perspective. And this area of 20,000, which has been such a big barrier for 2.5 years, could now be the new base. I think that's really the biggest takeaway coming from the activity of the last 2-3 weeks.
Right, okay, that's the target right now from a medium term standpoint for the markets. But I want to understand what the view is on some of those banks in particular, Gautam, given the fact that we have seen a pretty heady rally over the past few trading days. What's the best case scenario pre-election over the next 6 months or so for the Nifty Bank Index?
The market never looks strong when Bank Nifty underperforms. And that was the case for the last 3 months. If you look at what Nifty did, it was a very tentative looking rally. There was not much leadership. Reliance was not doing well. Banks were obviously not doing well. And IT index was in a bit of a difficult spot. But with this comeback of the Bank Nifty, I think the scenario has changed completely. The screen is looking a lot more vibrant. It's good to see the top stocks move in line with the Nifty and lead the Nifty. So this is a very good space because you always want the Nifty and Bank Nifty to go hand in hand. And with this breakout of the last 4 days, it does seem that the underperformance, which was there for 2.5 months, has ended, and now banks can actually continue to lead the market higher. Our working target for the Bank Nifty, now it's not too far at 48,000, so that's an inflection point. I think we will get there. But the key takeaway is some of these top stocks, SDFC Bank, ICICI, and particularly SBI, which we really like at these levels. I think they could see a special move over the next 3 to 6 months. So some focus from the mid caps to the large caps is definitely getting shifted, as most of your commentators might be talking about, and that's our view as well.
Right. Gautam, there is also that entire debate in the market on whether to reduce exposure to mid and small caps right now, because that's where the froth is now building up, and whether tactically move allocation higher to large caps because they're the ones which have lagged, and of course, the safer lot as well. Do you think that kind of distinction needs to be made?
Selectively, yes. I think large caps, cannot beat mid caps and small caps in terms of percentage return. You might say that they might do better, but then in terms of percentage moves, I'm pretty sure that mid caps and small caps still offer great value. Let's not forget the 17,000 crore or 16,000 crore pie that is coming into the system every month. A lot of it is now going into the mid caps and small caps. So what we are telling our clients and subscribers is to stay with top quality, stay with mid caps and small caps that have institutional interest, because let's not forget in the last 1 month, grade D and grade E have also done well. Everything is being painted with the same brush, And there are Excel sheets out in terms of earnings visibility for the next 10 years, which I don't think is a little fair to assess at this point of time. So top quality mid cap, small caps, the top 100 small caps is where the action will continue because it's getting a lot of money, it's under owned, and there is a lot more room on the upside. And clearly the India story is playing out through those 200 stocks, the top 100 mid caps, small caps. So large caps, yes, could do well because there could be a bit of a catch up, but don't ignore the mid caps and small caps, and don't reduce significant allocation there.
Okay, quite interesting there. So where are you finding value still within mid caps, and where do you think there are more legs to go?
See, there are newer themes, coming up every single day, Aisha. I think if you look at fertilizer, it's a space that we have liked in the recent past, and I think there are some big stocks which have coming out of long basis. So whether it's a Chambal fertilizer, GNFC, GSFC, Deepak fertilizer, I think this is an entire space that we like. We are also a big bull on sugar. I think we've recommended a few stocks there. Awadh Sugar, Balrampur Chini, I think has great potential from these levels. Dalmia Bharat. I think all of these stocks have potential. Not to forget power. I think JSW Energies of the world, Tata Power, CESC, look at the move that stock has seen after years. And I think that's happening in many, many pockets in the market. Infrastructure obviously is a great story as well. And among the large caps, I think IT and pharma, for me, from a risk reward perspective, offer a lot of value. I think pharma could be in outperformance mode for the next 6 months. All the top stocks, I think, can deliver anywhere between 15 to 20%. And IT, I think if you want a little bit of stability to your portfolio in the madness, in the craziness that's there in the market right now, I think IT, top quality IT offers great value as well.
So what happens to the runners of the market? Let's say power, defense, because see, for something to go higher, something has to make way. And for somebody who's got limited capital, I mean, the audience, what we have Gautam here, either is fully invested or they have limited capital. So they have two options: stay with power, defense, don't do anything, or switch out. What is a better strategy?
See, I think it depends whether your time frame is 5 years or your time frame is 6 months. Because we've seen so many stocks in the last 1 year that they complete their cycle and then just go into hibernation mode for the next 6 months. And newer stocks are participating. Look at the comeback in ITC. Look at the comeback in SBI. Look at the comeback in L&T. All of these stocks were doing nothing for the last 3 to 6 months. Power, I think, is a big structural story. Power, real estate, for me, are big structural stories. I've been a big bull on it all along. So you simply stay invested and don't look at day-to-day moves or day-to-day corrections. But defense and railway, I think it's very, very overdone at these prices. And if somebody got in really lower and is not looking at 3 to 5 years, take some profits, move to newer sectors.
Again, we go back to that same asset allocation model. Your view is that don't meaningfully change your exposure to small and mid-cap stocks. Now, there is a bit of a dilemma here because capital ultimately is limited for everyone. So if you don't switch out of mid and small cap stocks, and if large cap stocks offer a higher momentum proposition and greater margin of safety, so then what? Put more capital to work, leverage your portfolio. That's the only way you can perhaps buy them if you're not selling something.
Well, even if you don't want to put more capital at work, or if somebody does not have more capital at work, you should still stay with the mid caps and small caps. As a technician, I look for outperformance and underperformance. So when I look at the ratio chart, which is the mid cap index divided by the Nifty, that is at an all-time high. Don't understand mid caps in absolute terms. Look at mid cap index in relative terms versus the Nifty, and it's at an all-time high, and there is clearly a lot more room on the upside. So I think this mid-cap, small-cap outperformance is not going to end till at least elections next year. So I think that's the big opportunity. I know everybody's talking about large caps being a catch-up trade, but even if it's a catch-up trade, I don't have visibility beyond 10, 12, 15% in many of the large caps, but I do have a 15, 20, 25% visibility in many of the mid caps and small caps. So it's really a tactical call which one has to take. Some of the larger fund managers, larger players in the market like the large caps, but somebody with limited capital should stick to mid caps and small caps.
I say Tata, everybody will think goodbye. But from a market standpoint, Tata has been like a wealth creator group. From Titan to Trend, from Indian Hotel to Tata Consumer, some of these stocks have just hit out of the park. Now, how would you approach Tata Group of stocks? Now, it's a very isolated question because it's a sector which they represent. But guess what? With the exception of 1 or 2 Tata names, all Tata Group of companies are trading at P multiples which are highest in their respective sectors.
That's okay. I think that's a value unlocking which was long overdue. They always deserved a far greater multiple given the fact that they come from the Tata brand. So I don't think you really can say that because they are at such high multiples over many years, they should be sold into. And I think we prepare a lot of custom indices. So when we prepared the Tata custom index, we realized that it actually broke out of a 6-month consolidation a month back. And you must have seen the kind of move Tata Power has seen, Tata Consumer has seen in the recent past. Tata Steel also seems to be breaking out. I think, this is a group which is a pretty much a no-brainer. If you have to play the India story, if you want to participate in the markets aggressively, you just have to stay invested. There will be phases when it might not do as well. So be it. I mean, you cannot play this market 2020 on a daily basis. But as a long-term investor, Tata Group is clearly the best proxy to play the India story.
The most obvious names that one is pegging at within large caps are, HDFC Bank, Reliance, ICICI Bank, ITC. I'll skip Infosys out of the list, wherein they have the maximum weightage and the bearing on the index, and they're still quite a distance from their all-time peaks, both in terms of valuations as well as price action. Are these the names you're also tilting towards within the large caps?
Not really, Aisha. I think, it's over-owned, it's over-researched. And just because it hasn't done well in the last 3.5 months, I think a lot of people are hoping that they do well because, then the underperformance comes to an end. But I do believe that instead of an HDFC Bank, I would rather go the SBI way. I think SBI can beat some of the other private bank returns over the next 3 to 6 months. That's the bet that we are taking at Goldilocks, and we in fact even put out a recommendation a couple of days back. But the other top names, Reliance, HDFC Bank, ICICI Bank, ITC, L&T, as you mentioned, they will be market performers. There will be times when they will do well. Also, let's not forget we live in a synchronized world. This entire rally has been short covering driven. And once that short covering gets over, which I think is getting over at today's prices, I think things will go back to normal and, all of these stocks will go back into a range. So they might have done well, but don't expect them to do something special over the next 3 to 6 months.
Gautam, really appreciate your time. Thank you for joining us.